Welcome to this high-signal executive briefing. I'm really excited to dive into today's explainer with you. Look, for global executives and foreign investors looking at 2026, the big question about China isn't whether to invest anymore. It's exactly where to put your capital. Because as you're going to see today, the location you choose right now directly drives your corporate ROI more than almost anything else. Really, second only to the sector you're actually in. We're going to decode China's shifting investment landscape, breaking down the regional incentives and the strategic implications you absolutely need to know.
Let's just put the bottom line right up front. 15%, that one single number, it represents the massive corporate tax advantage that is currently up for grabs inside China's free trade zones. When you stack that up against the national standard rate of 25%, you instantly see why site selection is literally the ultimate lever for your profitability. And honestly, it's exactly why this briefing is absolutely critical for your 2026 strategic planning.
Okay, let's dive right into this. We've got 4 critical intelligence areas to map out today to optimize your China entry or expansion strategy. First, the high stakes. Then, the regional map. Third, strategic alignment. And finally, the negotiation playbook.
Starting things off with Section 1, the high stakes, specifically focusing on tax and talent advantages.
You know, with China's economy diverging the way it is, your site selection essentially dictates everything. We're talking supply chains, regulatory conditions, and crucially, your tax and talent advantages. Let's look at that tax landscape for a second. The standard national corporate income tax rate sits at 25%. But if you're operating inside one of China's 21 free trade zones, you unlock access to a reduced rate of just 15%. A great example is the Shanghai-Shenzhen-Hong Kong Cooperation Zone. They recently expanded it to cover over 120 square kilometers, and get this, that aggressive 15% rate is locked in there through the end of 2025.
To really anchor this concept, let's look at the hard data. Say you're a manufacturer generating 50 million RMB in annual taxable income. The difference between paying that standard 25% rate and the 15% free trade zone rate is staggering. That single policy differential saves your operation $700,000 every single year. That's pure margin, just dropping straight to your bottom line, entirely dictated by where you decided to draw your property line.
And this brilliantly illustrates your talent acquisition advantage too, because it's not just about corporate tax, right? To attract top talent, Shenzhen's Quanhai Zone actually exempts Hong Kong residents from paying the portion of individual income tax that exceeds Hong Kong's own salary tax burden. It effectively caps the tax rate at Hong Kong's progressive scale, which is 2 to 17%. Compare that to the mainland's 3 to 45% scale. So for a senior engineer earning, say, 2 million RMB annually, this location-based policy saves them up to $84,000 a year in personal tax. That is a massive hiring incentive.
Moving right along to Section 2, the regional map. We're going to navigate the 4 geographic tiers.
To cut through the noise of China's absolute vastness, we categorize the landscape into 4 distinct, actionable tiers. We've got coastal hubs, inland corridors, free trade zones, and specialized clusters. Each one of these is specifically engineered to solve different financial and operational challenges. Understanding the unique profile of each tier is exactly how you align your operational needs with the absolute best geographic base.
Let's compare those first 2. The dominant coastal hubs, think places like Jiangsu, Guangdong, Shanghai, they still account for over 55% of China's foreign invested manufacturing output. They give you the deepest supply chains and the absolute best logistics. But the trade-off is steep. Industrial land in Suzhou is now topping 2,000 RMB per square meter, and wages are climbing about 8% every year. Now flip to the inland corridors like Chengdu and Chongqing. Here, wages are a solid 30 to 40% lower than Shanghai, and Chengdu is actually hosting over 300 foreign-invested R&D centers right now. The catch? Supply chain depth and logistics are still catching up to the coast.
Building on that, our third tier, the free trade zones, goes way beyond just that incredible 15% corporate tax rate we talked about. They significantly reduce your operational friction. In the Shanghai Linggongnu area, for instance, you can get a company registered in just 3 working days. And even more strategically, this zone has published actual whitelists for data export in sectors like automotive and biopharma, meaning qualifying companies can transfer data overseas without having to slog through the exhaustive security assessments normally required under China's strict cross-border data rules. It's a huge time saver.
And our 4th tier brings us to specialized industry clusters. Listen, certain cities absolutely dominate specific sectors. Hefei, for example, has totally transformed into China's EV capital, hosting massive operations for NIO, Volkswagen, and BYD. Down in Shenzhen, the Nanshan district is home to over 180 listed tech firms. Over in Suzhou, BioBay hosts more than 500 biotech startups. The reality here is, if you operate in advanced manufacturing, green energy, or biotech, setting up shop anywhere outside of these specific hubs puts you at an immediate, day one, talent and ecosystem disadvantage.
So the crucial point is how you use this. Welcome to Section 3, Strategic Alignment, where we match business models to regions.
To actually turn this geography into a competitive advantage, you have to align your specific business model. If your model is cost-driven manufacturing, you need to be looking inland to cities like Chongqing or Chengdu to capitalize on those 30 to 40% lower wages. If your focus is innovation and R&D, you want to stay coastal, but look at sub-hubs like Suzhou or Hefei. There, you get talent parity with the top-tier cities, but at a 20 to 30% lower operating cost. And if you're export-oriented, free trade zones are basically non-negotiable. The customs facilitation and bonded warehousing in those zones will reduce your overall operational friction by an estimated 15 to 25%.
Now, what's really interesting here is the stark divergence we're seeing in the consumer market. If you're selling premium or luxury goods, Tier 1 cities like Shanghai and Beijing are still your target. They hold only 12% of the population, but they drive over 25% of luxury consumption. However, for mass-market consumer brands, the real growth story, the place you want to be, lies in Tier 2 and Tier 3 cities. We're talking about a rapidly expanding base of 300 million middle-income consumers.
Let's move into our final act for this briefing, Section 4, the negotiation playbook and how you maximize your leverage.
Because knowing the map and reading the published policies, that is merely the starting line. I really want this quote to sink in. Location incentives are negotiable. It's a blunt insight, for sure, but it is the absolute reality of the 2026 landscape. Provincial and municipal governments are fiercely competing for foreign investment right now. They want your business. So the incentives they actually offer often vastly exceed what you'll find publicly advertised on government websites. The real deals are happening behind closed doors.
Here is the exact leverage equation you need to know. If an executive can commit to bringing, say, 500 local jobs and 100 million RMB in registered capital to a region, you instantly have massive leverage. You can use those metrics to negotiate significantly discounted land costs, extended tax holidays, and aggressive relocation subsidies that go well beyond their published framework. Remember, you aren't just picking a site. You are negotiating a strategic partnership.
Let's bring this entire explainer right back to the bottom line with one final number. Remember we started with that 15% FTZ corporate tax rate? Well, for a mid-market foreign manufacturer generating 80 million RMB in annual taxable income, that 10 percentage point tax reduction saves over 1.12 million US dollars a year. Over a standard 5-year initial investment period, that single location decision compounds into over 5 million US dollars in retained earnings. That is $5 million you can reinvest into R&D or just repatriate.
Which leaves us with this final, crucial question to close out our briefing today. Is your current site selection leaving millions in unnegotiated leverage on the table? Look, with China's increasingly specialized regional hubs and these really aggressive local incentives, optimizing your geography is no longer just some administrative task. It is a core strategic mandate. Thank you so much for joining this explainer. Take these insights, reevaluate your China footprint, and go maximize your leverage.